If you've been researching rental property investing, you've probably heard about something called the 1% rule. A lot of beginner investors treat it like some kind of golden rule for finding a good deal. The idea sounds simple. If a property costs $200,000, it should rent for about $2,000 a month. That's the 1% rule. And at first glance, it sounds pretty reasonable. But here's the problem. In the real world, the 1% rule doesn't tell you whether a property will actually make money. In fact, if you rely on it too much, it can actually lead you straight into a bad investment. So today, I want to break down what the 1% rule really is, why so many beginners rely on it, and more importantly, why it often fails. And I'll also show you what I personally look at when analyzing a rental property. Welcome to Real Estate Simplified. I'm Bill Simmons. I've been investing in real estate since the 80s. Flips, rentals, multi-units, 30 plus years before I became a realtor. So I've learned a few things about the investor side. And one thing I've learned over the years is that simple rules are helpful, but they can also be misleading if you don't understand the bigger picture. Real estate investing is about understanding the numbers, not just one number, all of them. So let's start with the basics. The 1% rule is basically a quick screening tool investors use when looking at rental properties. The concept is simple. The monthly rent should be at least 1% of the purchase price of the property. For example, if a house costs $200,000, the 1% rule suggests it should rent for $2,000 a month. If the house costs $150,000, then ideally it should rent for $1,500 per month. The idea behind this rule is that properties meeting that threshold are more likely to generate positive cash flow. It's quick, it's simple, and that's why so many beginner investors love it. You can scroll through listings and quickly say, this one works, this one doesn't. But here's where things start to fall apart. The reason the 1% rule became popular is because it's easy. And let's be honest, real estate investing can feel overwhelming when you're starting out. There are a lot of numbers: purchase price, renovation costs, taxes, insurance, maintenance, vacancy. So when a new investor hears about a simple rule that supposedly helps identify good deals, it feels like a shortcut. But shortcuts in investing can be dangerous because the 1% rule doesn't account for most costs that determine whether a property actually makes money. And that's where the real problem starts. The biggest flaw with the 1% rule is this. It only compares rent to purchase price. It doesn't consider expenses. And expenses are what determine your cash flow. Let's walk through an example. Imagine you find a property for $200,000. According to the 1% rule, it should rent for about $2,000 per month. Let's say it actually does. Sounds great, right? But now let's start subtracting expenses. Property taxes, insurance, maintenance, repairs, vacancy, possibly property management. All of those costs come out of that $2,000 per month. Suddenly, that deal that looked great under the 1% rule might not be great at all. Another major issue with the 1% rule is that real estate markets are very different across the country. In some markets, finding properties that meet the 1% rule is common. In others, it's nearly impossible. For example, in higher price markets, property values may have increased faster than rents. That means you might never see the 1% rule, but investors are still buying rental properties there and making money. How? Because they're looking at their overall returns, not just one rule. On the flip side, sometimes you can find properties that technically meet the 1% rule, but still perform poorly as investments. So the rule can fail both ways. Here's something a lot of beginner investors underestimate: taxes and insurance. These two expenses can vary dramatically depending on location. Two properties with the same price and the same rent could have completely different tax bills. One property might have $2,000 a year in property taxes. Another might have $6,000 or $7,000. That difference alone can wipe out most of your cash flow. Insurance is another factor. In certain areas, especially places prone to storms or flooding, insurance costs can be extremely high. Again, the 1% rule doesn't account for any of that. Another thing the 1% rule completely ignores is rehab costs. A property might technically meet the 1% rule based on the purchase price, but what if that needs $40,000 to $50,000 in repairs? Now your total investment is much higher, and the rule no longer makes sense. This is why I always emphasize the importance of knowing the numbers, understanding the true cost of the property, not just the listing price. Every rental property experiences vacancies. Every rental property requires maintenance. Those two factors alone can have a big impact on your returns. Even a well-maintained property will eventually need things like new appliances, roof repairs, HVAC systems, plumbing issues, paint, flooring. These things are part of owning rental property. But again, the 1% rule doesn't include them. Now, with all that said, experienced investors sometimes still use the 1% rule, but they don't treat it as a final decision. They treat it as a quick filter, a quick way to quickly identify properties worth analyzing further. In other words, the 1% rule might help you decide whether to spend 5 minutes looking at a deal or move on. But it should never be the only thing guiding your investment decision. When I analyze rental property, I focus on a few key things. First, I estimate realistic rent. There are tools that can help with that, like Rental Meter, which lets you compare rents for similar properties in the area. Next, I look at the after repair value, also known as the ARV. That means checking comparable properties that have recently sold in the neighborhood. I compare things like bedrooms, bathrooms, square footage, condition, location, updates, garage, lot size, and I try to use recent sales whenever possible, ideally within a year. Another major factor is understanding renovation costs. This is where having good contracts become incredibly valuable. And apparently there's an app for that, but I don't use them, so don't ask me about them. Over time, you develop relationships with electricians, plumbers, drywall installers, and other trades. And once you've done enough projects, you start getting a feel for what things cost. That experience helps you evaluate deals much faster and much more accurately. Everyone develops their own investing philosophy. Mine is pretty simple. I like buying properties that I would personally feel comfortable living in myself. That doesn't mean they have to be luxury homes, but they should be clean, safe, and in a decent neighborhood. Properties like that tend to attract better tenants and perform better over time. If there's one thing I've learned over the years, it's this. Successful real estate investing isn't about finding magic formulas. It's about understanding the full picture of the deal. That means analyzing rent, expenses, repair costs, market conditions, property condition, tenant demand. All of those things together determine whether investment makes sense. The 1% rule isn't completely useless. It can be a quick starting point when you're looking at properties, but it should never be the only rule you rely on. Real estate investing requires a deeper understanding of the numbers. And the investor who takes the time to learn those numbers are the ones who usually succeed. Now, if you found this video helpful, hit the thumbs up and consider subscribing for more real estate investing tips and strategies. And let me know in the comments what topic you'd like to see. Thanks for watching, and I'll see you in the next video.